Hey everybody, we recently did a video about two stocks that we've sold, Tyler Crowe and myself, and a lot of people were kind of curious as to, why we sell stocks and have we sold any other ones? Do we have any other positions we'd like to unload? And it just so happens Tyler is raising a lot of capital in his portfolio right now, apparently. Tyler, I think you said you've sold about 13 stocks recently, is that correct?
Yeah, I think in the last month I've sold about 13 stocks total.
All right, so we're going to get into that in a second. I have some questions. I am made of questions when I hear that you sold 13 stocks. But before we do, please take a minute and check out the link you see on your screen for a message from my sponsor, The Motley Fool. You get the top 10 stocks to buy right now, and it's a great way to support this work we're doing on YouTube. So, my first reaction when you said you've sold 13 stocks, we heard about one of them last week when you said you sold Iron Mountain, which surprised me because it's doing so well, stock price wise. But I hear that you sold, a baker's dozen of stocks, are you raising money for something in particular? Do you think the market's overpriced, or is it just that you see better opportunities to allocate your capital, or all of the above?
I, it's very much the third one. It's the well, a combination of the future expected returns of the companies that I sold. So a lot of valuation kind of went into it, as well as opportunities that I saw elsewhere that I thought had better future expected returns. And so yeah, I kind of broke it all into like three buckets. There was a couple where it was like, yeah, this thesis might be broken, and so let's walk away. A couple of them are like, no, I could revisit them at the right time, but based on, the next couple of years, they look a little expensive, and I think there might be better opportunities down the road. And then like I know the one we're teasing here, so let's just get it out of the way. I sold all my Apple stock, and the reason I did it was it's a valuation thing, and we can we can dig into that a little bit more. But yeah, that kind of the three buckets of like the 13, 14 stocks that I sold.
So I know you shared, I think, about half of your list with me before we recorded. And one thing I noticed is that they're mostly large cap companies. So I have to kind of think that this has to do with the discussion we had last week, where you think that most of the opportunities are in the smaller cap end of the market right now, whereas the small caps are going to generally outperform. Would it be fair to say that that kind of is definitely playing into the what you're selling and what you're buying right now?
Yeah, and large cap doesn't necessarily mean like I just sold them because they're big, but it also happened to be a lot of like slow growth large cap stocks that, even though they're, only projected to grow quite modestly over the next couple of years, they were still trading at pretty high premiums. And so I just looked at it and said, well, why would I hold on to a company that's maybe going to grow 2 to 3% annually for the next 3, 4 years, that's trading for 25, 30 times earnings, when I can see other opportunities growing at 10 to 12 that are trading for less than book value? And so it was a lot of that trade off of just looking and seeing other opportunities elsewhere and just being like, do I need to hang on to these things just because I've hung on to them? Or, if I don't think they're going to do great for the next few years, I can always revisit them in the future. Why not chase something out or look for better opportunities now?
So you've already revealed one of them, Apple, that I'm really curious about. And the reason I'm curious about that one is because I sold all of my Apple about a year ago. That was my like late 2022 sale, and I think our reasons are very aligned. That it's just more of a limited upside thing from here. It's a company that, unless it has the next iPhone, which I don't think, like, the Apple, the whatever, the Pro headset, whatever they call that. I don't think their augmented reality or AI devices or anything like that are going to be the next iPhone in terms of sales. So that was kind of where my head was at, is that the big innovations have already happened. The chance of them having another, massive hit or a needle moving hit besides their current businesses is rather small. And yes, the services business is growing impressively. Yes, profits remain strong. Yes, they have more pricing power than any other electronics maker, but they're also an expensive stock, right? And I know that, you have to ask yourself the question, is the price reflective of the opportunity? And in my mind, with Apple, the answer was no.
Yeah, For me, it kind of, I think one of the things that's a little deceiving when it comes to Apple is a lot of people see the extremely large numbers and go, oh my goodness, how can that not be good, right? You'll hear things of like $50 billion share buyback programs or something like that. And just, or, this $20 billion huge gain that they're going to get from, like you said, services or uh, it doesn't really matter where it's coming from, but you can throw out a huge number like that and it sounds great. But then you look at it and go, oh, so it's going to boost the bottom line by like 4 or 5%, and you're going to buy back maybe 3% of your shares over the next couple of years because this is a $3 trillion company, and that's can be kind of hard to wrap your mind around. And right now, at currently trading at 32 times earnings, it is a great business. It's an incredibly durable business. It has, like the services ecosystem. It's provided a little extra sliver of growth, but that growth has been modest by like all definitions. You're not seeing fast growth from Apple. It's durable growth. It's all the things you would want out of a very quality business. And I would never uh, say it's a bad idea to continue to hold stocks like Apple, but at 32 times earnings, it just looks too expensive for its expected future returns. When I bought my shares of Apple 10 years ago, it was a stock that traded at 12, 13 times earnings, which I think for a lot of people today, you hear 12, 13 times earnings for a stalwart company like Apple and think that's inconceivable. But that happens. It's happened before. It could happen again. And if an opportunity arises where something like Apple is trading for 12, 13 times earnings, you better believe I'm going to go back and reinvest in it. But at 32 times earnings, it really looks to me like a stock that is priced for a, a level of growth that I don't think the company can attain.
Yeah, I would agree with that. The other one I wanted to ask about is one that it's not so clear to me why you sold, and that's Waste Management, ticker symbol WM. And in my mind, not only is Waste Management kind of a near monopoly on what it does, it also has a lot of potential when it comes to, you know, renewables and efficiency and things like, recycling, and all of that is still kind of evolving in a lot of ways. So is this more of a valuation question, or you don't see a lot of growth potential because how much more garbage could we possibly have, or something to that effect?
It's a little bit more on the future returns thing again with kind of this next couple of years. It's going through a larger than usual capital expenditure program. So much so that it's going to reduce free cash flow and not allow it to do some of the things that it has done to create value, like buy back a lot of stock and raise its dividend at really fast rates. This particular investment program that they're doing is to expand what's called its renewable natural gas business because landfills produce a lot of methane as things decompose. They collect it, they're able to kind of scrub out the impurities, and it's used as a transportation fuel or basically anything you use natural gas for. And also with things like the Inflation Reduction Act and a lot of the investments that they're making in renewables, green technology, and kind of the credits you can receive, it's eligible for credits there. So it's just plowing a lot of money into this right now, which is great. It's good to hear over the long term. But based on management's projections, they're saying that in 2027, after we've made all of these investments, we're going to generate about $4 billion in free cash flow in 2027. And at the current price, or at the time that I sold the stock, it was trading at 17 times its 2027 projected free cash flow. So I would have to pay more or less pay what I would consider market rate for something that's going to happen 3 years from now, which to me sounds a little unreasonable. And it goes back to that pricing thing. I think this company is going to, over the next couple of years, slow down its growth, and free cash flow is going to drop precipitously because of this spending plan. And I think there's going to be opportunities maybe to reinvest down the road after some valuation contraction to reflect what I think is an overvalued stock right now. And it's because of that why I've sold. I don't think Waste Management is going anywhere. It's a great business. It's one I've owned for probably 7, 8 years now. But because of this transition phase, I think there's some execution risk there, and not 100% certain that it gets to that projected cash flow 3 years from now. And based on trading prices, it doesn't make a whole lot of sense for me when I see other opportunities elsewhere.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.